Every dollar you pull from a traditional IRA or 401k in retirement gets counted toward your Medicare premiums, pushed against the threshold that decides how much Social Security gets taxed, and tracked by the IRS. There are three accounts that work completely differently, and most retirees over 65 have never opened one. The first account is a Roth IRA. And the reason it is invisible to the IRS in retirement is not a loophole or a technicality. It is the way the account was designed from the beginning. When you contribute to a Roth IRA, you use money you have already paid taxes on. The IRS takes its share on the front end when the money goes in, not when it comes out. So when you withdraw from a Roth IRA in retirement and you are over 59 and a half and the account has been open for at least 5 years, the distribution is completely tax-free. No federal income tax on the withdrawal, no state income tax in most states. And here is the part that changes the retirement picture for people who understand it. Qualified Roth IRA withdrawals are not counted toward your modified adjusted gross income for Medicare purposes. This is the formula Medicare uses to decide whether you owe a surcharge called the IRMAA on top of your standard Part B and Part D premiums. In 2026, that surcharge kicks in for single filers with income above $109,000 and for married couples above $218,000. Every dollar that counts toward that number costs you money in Medicare premiums the year after next. Every dollar from a qualified Roth IRA withdrawal does not count at all. The same Roth income is also excluded from the combined income formula the IRS uses to decide how much of your Social Security becomes taxable. That formula uses your adjusted gross income plus tax-exempt interest plus half of your Social Security benefit. Traditional IRA withdrawals go directly into that number. Roth IRA withdrawals are not in the formula. For someone sitting close to the threshold where 50% or 85% of their Social Security benefit becomes taxable, a single shift from pulling money from a traditional IRA to pulling it from a Roth can be the difference between owing tax on most of their Social Security income and owing none of it. The Roth IRA also never requires a required minimum distribution from the original account owner during their lifetime, which is a distinction that becomes more valuable the older you get. While every dollar in a traditional IRA or 401k becomes subject to mandatory annual withdrawals starting at age 73, your Roth IRA can sit untouched forever if you do not need the money, continuing to grow tax-free without the IRS forcing a distribution. Before we get to the third account, which is the one most retirees have the biggest misconception about, subscribe now, because the way that account interacts with Medicare premiums is something that surprises even people who have worked with financial advisors for years. The second account is a health savings account, which goes by the letters HSA. And the reason most people over 65 have never opened one is that by the time they reach Medicare age, they can no longer contribute to it. You can only contribute to a health savings account while you are enrolled in a qualifying high-deductible health plan, and once you enroll in Medicare Part A or Part B, your eligibility to contribute ends. But if you opened and funded one earlier, even years before retirement, what you have built up inside that account can be drawn down tax-free for any qualified medical expense for the rest of your life, with no deadline and no required withdrawal schedule. Here is what makes this account particularly powerful for retirees managing their Medicare costs. Qualified withdrawals from a health savings account used for medical expenses are not counted toward your modified adjusted gross income for IRMAA purposes. You can pay your Medicare Part B premium directly out of your health savings account, which is itself a qualified medical expense, and that payment does not increase the income number Medicare uses to decide whether you owe a surcharge. You can pay for prescription drugs, dental work, vision care, hearing aids, and long-term care insurance premiums, all from this account, and none of those withdrawals add a single dollar to your Magi. For a retiree sitting at $107,000 in income and trying to stay under the $109,000 IRMAA threshold, routing $4,000 of medical expenses through a health savings account instead of paying out of pocket from cash can be the exact move that keeps them off the surcharge tier entirely. The health savings account also has a feature that almost nobody talks about, and it is one of the most underappreciated rules in the entire tax code for retirees. After age 65, the 20% penalty for withdrawing money for non-medical expenses disappears entirely. The account functions like a traditional IRA for any spending after that age. You simply pay ordinary income tax on non-medical withdrawals, which is the same treatment any traditional IRA withdrawal gets, except that the health savings account never had a required minimum distribution requirement. There is no IRS mandate forcing you to withdraw from it at any age, and the third account is a cash value life insurance policy. And this is the one that generates the most confusion, because most people think of life insurance only as a death benefit. The part that is relevant to this conversation is not what happens when you die. It is what happens to the cash value that builds up inside a permanent life insurance policy while you are alive. When a properly structured permanent life insurance policy builds cash value over time, that value grows tax deferred, similar to a retirement account. But when you access it, you can take loans against the policy rather than outright withdrawals, and policy loans are not considered taxable income. Under the Federal Tax Code at Internal Revenue Code Section 101, life insurance death benefits are excluded from gross income. And policy loans from a properly structured contract, meaning one that does not cross the line into what the IRS calls a modified endowment contract, are also not reported as income, are not counted toward your adjusted gross income, and therefore do not affect your Medicare premiums or your Social Security taxation at all. A retiree who needs $40,000 for living expenses in a given year and takes it as a loan from a properly structured cash value life insurance policy has not increased their magi by a single dollar. The same $40,000 from a traditional IRA would count fully as ordinary income. The catch is real and worth stating clearly, and the script would not be doing its job if it left it out. This strategy requires the policy to have been properly structured and funded over time, which is a multi-year process that needs to happen well before retirement. Policies that are overfunded too quickly can be reclassified by the IRS as a modified endowment contract, which eliminates the tax advantages. And unlike the Roth IRA and the health savings account, this is not a straightforward account that most people can set up independently without professional guidance. So here is how these three accounts connect. The problem most retirees face is that their traditional IRA and their required minimum distributions are essentially on a collision course with their Medicare premiums, their Social Security tax exposure, and their overall tax bracket. Every mandatory withdrawal adds income. More income pushes more Social Security into the taxable zone. More income can flip Medicare into a surcharge tier based on income from 2 years earlier. And more income means a larger required minimum distribution the following year because the account has grown while generating that income. The Roth IRA, the health savings account, and a properly structured cash value life insurance policy all share one fundamental characteristic. The income you generate from them does not feed that loop. None of them are reported as income in the combined income formula. None of them trigger the IRMAA surcharge calculation. None of them push your Social Security benefit further into the taxable zone. And none of them carry the required minimum distribution rules that force you to take money out whether you need it or not. Most retirees over 65 have never opened one of the three, not because they could not have benefited from it, but because the financial system defaults to the same set of accounts for everyone, and the nuances of how different account types interact with Medicare, Social Security taxation, and required minimum distributions are rarely explained in the same conversation. A traditional IRA is the most heavily marketed retirement vehicle in the country, precisely because every dollar that goes in reduces taxable income right now. The downstream cost of those future withdrawals in terms of Medicare premiums, Social Security taxation, and mandatory distributions does not show up until decades later, when it is much harder to reverse. Always speak with a qualified tax professional or financial advisor before making any decisions about account types, conversions, or new policies, because the details of your specific income, age, and account structure matter significantly. If any of these three accounts surprised you, drop a comment with your age and which one you are going to ask your advisor about this week. And if this helped you see something you had not considered before, Subscribe so you do not miss the next video, because there is always more sitting inside the tax code that nobody explains in plain language.